Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Mirza. It's great to have you on the podcast show.
Thanks a lot, Bilal. It's a pleasure being on.
Great. Now, before we go into our conversation, I do always like to ask my guests something about their origin story. So it would be great to know, in your own words, what you studied at university, and then was it inevitable you'd end up in finance and some of the key milestones along the way?
My origin story, it's all about bananas. See, my brother is my elder by 7 years. So when I was in middle school, he was a sophomore in university. And as all younger brothers do, I used to go through his stuff when he wasn't around. And that's how I came upon his economics textbook. It was Paul Samuelson's Introduction to Economics. It's like this thick. Chapter 1 was about the economics of the bananas market. Now, economists love bananas because, it's a generic product. There's not much scope for branding. So very, very flat supply curve and downward sloping demand curve. So it's very good for explaining things like market structure and price elasticity. And look, middle school me got it. And I was hooked. I thought it was really interesting. And when I was in university, partly studying economics, I got an internship with Deutsche Bank, lucky enough to be in the FX research department, which either you or Binky was running at the time, actually. And it was an amazing experience. I saw a Bank of Japan intervention and a lot of speculation about dollar-China depegging at that time. And it was a very fascinating time, which always is in markets. And I think I was really hooked. So that's how I ended up here.
Right. No, that's great to hear. And you've seen a lot of stuff in recent years as well. So maybe we can start with that. So your main focus at the moment has been on emerging markets globally. And so how would you characterize the performance of emerging markets over the last, say, 4 or 5 years?
Not great. EM stocks on an index level have underperformed DM, developed markets, since COVID. Hard currency bonds have underperformed US high yield credit. And local currency unhedged bonds have underperformed hard currency. Money chases returns, and the underperformance in the last few years has led to much lower interest from foreign portfolio investors. That's why levels of foreign ownership across local markets and EM equity markets are way down. In my own circles, from what I see, a number of my friends in Hong Kong who used to be really high-flying China equity portfolio managers are now out of a job. When I discuss asset allocation with global real money, EM usually comes up last, almost as an afterthought. EM dedicated pods in multi-strat hedge funds have been forced to narrow the range of trading strategies that they employ. And they've also started to trade a lot more developed markets product just to, compete for capital with other pods. And an example of this is, as you know, I'm based in Canada now. And I'm surprised by how many of my friends and clients who are based in Singapore or Hong Kong, they're basically up at night trading US products in US time zone. Some of them are online during US time zone and offline during Asia time zone. So, and I think that's an indicator for the fact that the underperformance of EM has driven out a lot of the investor interest as well. And has left people, I think, very underallocated towards EM assets.
It sounds quite pessimistic. The tone that it hasn't been a great story for the last number of years. But is there some benefit to investing in emerging markets, just from a sort of high level perspective?
Oh, high level story is always great for EM because demographics are usually quite good when you take out countries like China, Korea, Taiwan. Technology leapfrogging. So, for example, you drive out in the UK countryside or even in Canadian countryside, you'll find a lot of things called telephone poles with telephone wires. But EM has been able to, a lot of EM countries are leapfrogging that technology straight to 5G. You don't see necessarily large amounts of banking networks, but you see everybody holding a phone, making digital payments and engaging with digital banks. So EM, by not having technology before and now rapidly getting it, is probably able to leapfrog a lot of the steps that DM took along the way, which should bode well for more domestically generated service economy growth. EM in this particular cycle also has better fiscal finances than DM, because most DM countries did not or were not able to stimulate as aggressively through fiscal policy as the US and Europe did. And so nominal growth has been able to keep up, and they've been able to reduce their fiscal deficit. So if and when investors start focusing on fiscal policy, EM will be seen more as a poster child. But yeah, I mean, past is past and future is future. And I didn't want to project an idea of pessimism. I wanted to say how underallocated people are, which is actually, in my view, a very positive sign for the future.
Absolutely. Now let's talk about the here and now. With emerging markets, we have to start with China, and I guess in general, when we talk about emerging markets, it isn't just one homogenous asset class. It's very distinct, different sort of areas. And so let's start with China.
Sure.
How would you characterize what's happened to China this year, and what's your outlook for China?
So we did do a podcast with Liang, my colleague, who's a China specialist. And look, I mean, some of the things that we covered was this huge contrast between extremely depressed consumer sentiment in China versus a hyper success in specific sectors. The Huawei Pura 70, which is the latest phone from Huawei, supposedly they have the highest China-made components in its models. Now, I don't know. I haven't seen the phone. I couldn't even name half the components within the phone. I'm not a tech person, but this is what the company says, that this is the highest China-made components of all of its models. And they're massively outselling iPhones in China. That's something. I mean, we don't get this phone abroad, but they do in China, and they get the iPhone as well. But those people are choosing the Pura 70 as opposed to the iPhone's latest models. Chinese EVs were a joke 10 years ago. And now the West is desperately trying to keep those models, keep those cars out of their own markets, because they will bankrupt their own car companies. So there's definitely this hyper success in specific sectors, but there is also this kind of 15-16% youth unemployment rate, persistent deflation, industrial prices continue to fall, which kind of highlights an economy where consumer demand is just extremely weak. And the focus of policy stimulus, which typically is on supply side development, simply just creates more product which consumers can't buy. So it's basically, consumers won't buy. So it's basically kind of, a balance sheet recession in the wake of a property market downturn. And the economy is humming along or chugging along or dragging along on the back of a few specific sectors and becoming hyper competitive in the export markets. So there are these two contrasting pictures on the Chinese economy. When you trade Chinese product, I mean, Chinese stock market is back at the lows. We bounced off of these levels earlier this year on the back of very substantial buying intervention from Chinese national team, and on the back of certain policy measures which the authorities took, including what we called housing market QE and kind of passive expansion of fiscal deficits. The market needs more. Those measures, after eliciting a little bit of excitement, have now come back to the same point that China is still deflating and policy is not stimulative enough. So Wall Street has started to float massive numbers once again about how much more easing China needs to do to get out of this deflationary trap. I mean, from the financial media, I see people are floating numbers of 10 trillion, 20 trillion necessary stimulus, which the government needs to do. But the government is clearly dragging its feet. They clearly don't want to do too much at this point in time. When you take a look at the specific measures which they have done, they make sense. So there's some degree of removal of the excess inventory from the property market through direct fiscal purchases. There is some degree of mortgage rate reduction. There is some kind of a focus on letting the fiscal deficit widen passively because revenues are weak, so not compensate for that. So essentially use more fiscal issuance to offset the lack of credit creation in the economy. But these measures are turning out to be more like pushing on a string. So they're not really large enough to affect the macroeconomy as a whole. So that's affecting everything from, the Chinese asset prices to demand for commodities. And I think you still have this kind of picture that while there is some hyper success in certain sectors, the overall weakness of consumer demand in the wake of the property price implosion, property market implosion, is still an ongoing process.
And this hope around some kind of big policy stimulus, that's not really going to happen.
I won't say it won't happen. I think the Chinese leadership needs a stronger push. Things can change quickly in China. I remember when the COVID lockdowns were in place, there was a huge amount of narrative that since these lockdowns are Xi Jinping's pet project, they will never be changed. And then there was a few protests in the street, and within a month, the whole thing changed. And from the point of them deciding to change, within a month, the entire economy was open. So things can change, but I think we need to reach a level of pain, which then forces that change.
Okay, understood. Now, if we sort of generalize more to emerging markets as a whole, we're very likely to have a Fed cutting rates very soon. And so obviously what the Fed does then has an impact on broader EM. So how do you think about emerging markets in the context of upcoming Fed easing cycle?
So there are three main factors that drive returns in EM assets from a dollar-based investor's perspective. First is relative growth, second is global liquidity, and the third is the dollar. Now, these factors are interrelated, especially post-COVID, because US has had above-trend growth. Most EMs have had below-trend growth, and that in turn has prompted a tightening of policy, especially in the US, more so than anywhere else, which in turn has fueled a strong dollar. So looking forward, I expect liquidity and dollar factors to be a lot more supportive for EM assets, with US interest rates expected to decline and the dollar having peaked. The bar is going to be a lot lower for EM assets, at least how relative to the last few years. Now, the relative growth factor is debatable. But I also think that the underperformance of EM growth is in the price. On forward earnings, MSCI EM trades at 12, while US S&P trades at 22. I mean, the difference is the largest that we've had in 20 years. And given our starting point in valuations and relative positioning, I think the risk-reward setup for EM in the next 12 months is pretty bullish. I would add, though, that like you said, I mean, we shouldn't think of EM as homogeneous asset class. I mean, when you're buying EM, let's say EM MSCI stocks, you're basically buying like 25% China, 20% India, and 15%, 10% Korea and Taiwan. And then kind of like small allocations to a lot of other countries. So it is a very highly concentrated bet. And most institutional investors, they think of EM now as a bunch of diverse country stories. And I think that's the right way. I think investors should be looking at Asian currencies. There's a beta to the yen, of course, with shades of a similar long dollar carry trade, which was built up by local corporates because of high US interest rates. Asian bond markets are also attractive for their relative stability. And a lot of the foreign investors who own local currency bonds have also hedged out the currency risk, because by doing so, you essentially boost the yield on the bond that you hold. The act of currency swapping essentially adds yield to a bond portfolio. And so as US interest rates go down, that rate differential goes down and the forwards move against you. And so those positions then need to get unwound as well. So there are a lot of these kind of local carry trade factors that are also adding to the appeal for Asian currencies as US interest rates decline. India is a case in point. I mean, India is delivering 6 to 7% real growth with 3 to 4% inflation. South Africa, I think, is a special mention with some hopes of improvement in the governance structure. Mexico and Brazil will be high risk, high reward. But look, China is the big call. there's been a lot of focus on the yen carry trade. The yuan carry trade is also quite substantial. We can see that in the spot vol correlations. Now, spot vol correlation is just a correlation between the currency and its volatility. Now, usually in a country like China, when dollar China goes higher, that is to say, when RMB starts to depreciate, volatility goes higher. And that reflects the fear, that reflects the fact that the market is scared of further depreciation of the RMB. Usually that is because people own the local assets. So when the currency starts to fall, they panic and they sell. And they try to buy volatility to cover their exposure. But what's happening recently is that as dollar China has gone down, implied volatility has exploded. So it's actually quite the other way around. So this time, it actually looks like the risk for the market, the scenario that the market is scared of, is a appreciation of the RMB, which I think is a reflection of the broad carry trade that is built up in dollar China, very similar to dollar yen.
Okay, yes, understood. Now, I mean, with Fed easings, often what coincides with Fed easings are recessions as well. So, if we were to see a recession, or I mean, if you think there is going to be a recession, but if we were to see a recession, how would EM perform then?
Very good question. Now, I think there are, first thing again, we have to look at the starting point. In the last year or so, Asian economies, including China, have been very happy to ride on the coattails of the US economy. So they've basically relied on export growth, and they haven't done a great deal of stimulus, and which is why exports have basically driven the recovery in Asia. Especially China is heavily dependent on exporting at this point in time. Now, in the global economy perspective, Europe isn't doing very well. China isn't doing very well. And really the main source of growth for most economies has been exporting to the US. Now, if the US also kind of like falters, then that source of growth is gone. And that puts policymakers in local economies in a difficult position because growth will very likely be weaker. That the fact that weaker growth in the US will also mean lower interest rates will allow for local monetary policy to be also lowered, and that will provide some degree of offset to the decline in growth expectations. But it's going to be hard for some economies, especially who are very export-oriented, to be able to find new sources of growth unless China steps up. And I think that's something which we have to be on the lookout for. As I mentioned, I think Chinese policymakers will probably react, but they need a larger dose of pain. And if the real only source for growth in China really starts to falter, then I think it might start to shift some of the gears in policy thinking, and we might actually get some degree or a larger stimulus from China. If that were to happen, it would actually be very good news for the global economy, because as the US economy is weakening, Chinese economy might actually start to strengthen. Now, at this point, this is more of a hypothesis or a forecast. I don't necessarily see the Chinese authorities pumping up stimulus at this point in time. And we may need to go through some sort of an adjustment or a pain process before we kind of like come to this nice, happy zone. In short, a sharp recession in the US economy is going to drag the entire world economy down. And even though that will come with lower interest rates and higher liquidity, it will also mean some degree of pain for local assets that are geared towards export-oriented growth. Some economies are very directly linked to the US. Mexico, for example, is very heavily relying on the US, whereas North Asia is also quite heavily relying on the US, the likes of Korea and Taiwan. But some economies, especially India, South Africa, Southeast Asia, they are less dependent on export-oriented US growth. So there will be some differentiation within EM as well.
And the other US factor, we're talking about lots of US factors, which tells you something here, but we have an election coming up. Potentially quite stark differences between the Democrats and the Republicans with Trump and Harris on policy, especially in regards to tariffs and US-China relations. How do you see each candidate's position in relation to how that would affect EM?
So I think about this as in the following way, purely from the perspective of what this means for EM. I see potential President Harris leading to policies that will diminish the appeal of U.S. assets. This could come in the form of higher corporate taxes. It could come in the form of unrealized capital gains, all the stuff that's being talked about. It could also, so essentially, in that scenario where the US kind of reaches the limits of its growth and the focus kind of like turns away from US outperformance, that I think could actually lead to more of a rotation of flows towards EM. So I would see a Harris presidency as raising the bar for US assets and lowering the bar for EM assets. Is the opposite true? Could Trump and all those tariff stuff lead to a much stronger dollar and more hollowing out of EM, given the fact that EM is depending on exporting? Well, I'm not too sure about that. I mean, I think if Trump comes in and puts a 60% import tariff on China, that could just be the very catalyst that we need to get Chinese policymakers to start to really focus on domestic consumer demand and really aggressively stimulate the local economy. They'll need an offset. China can't survive without growth. Perhaps that is the very doom and gloom that is necessary to create a change in paradigm. So I wouldn't I mean, if Trump comes in right now, the probabilities shift a lot. I think there will be some short-term weakness in the RMB, in EM assets, some strength in the dollar, but I have a feeling it could play out just the other way.
Okay, no, that's interesting to hear your opinion there. So if we just run through regional views and what you think the best positions are to have in each, in your own view. If we start with China, you mentioned earlier that stocks were trading poorly, but at the same time, you said valuations were cheap. You mentioned the possibility of further easing, so that suggests lower yields. And then you mentioned the yuan carry trade. I mean, how would you position best for China right now?
So yes, I think at some point when the Chinese policymakers turn around, the stock market fortunes will improve. But I think there's a graveyard full of people who have tried to preempt that and got caught out. So I think it's better to see the gear shift, miss the 5-10% if you must, and then get involved. So we are at the lows in stocks, and I do see that sentiment is once again turning very doom and gloom. All the China bulls have disappeared, and now all the bears have stepped forward, and that's usually a good contrarian indicator. But at this point, I think it's worth simply watching to see, when authorities really start to shift policy. As far as the currency is concerned, I think dollar China is more about the US dollar getting weaker rather than the RMB getting stronger. And that has to do with the fact that as US interest rates fall, then the incentive for Chinese corporates, for anybody who has Chinese assets, to maintain a high dollar ratio. And we've done some work to figure out, how long dollars Chinese corporates have become. I mean, they're running monthly trade surplus of $100 billion. And every month, Chinese banks have had to sell dollars to try to stabilize the currency until last month. So there's clearly a large overhang that's built up. You have to be a little bit more specific about those numbers, because a lot of the reasons for why Chinese companies are keeping dollars abroad is simply to invest in other countries. And Chinese car makers, for example, are expanding manufacturing abroad to try to circumvent tariffs, and there's a lot of that going on. So there's a lot of Chinese ODI as well. But broadly, there is a decent buildup of dollar longs that has happened. And as US interest rates come down, my base case is we could find ourselves around 690, maybe 7 for the next 3 to 4 months. Maybe a little bit more if Harris wins, and maybe with a more two-way volatility if Trump wins. Clearly, the US elections factor is going to be important. But look, I mean, we've been in a 710, 730 trading range all year. that trading range is going to expand. It's probably going to expand on the downside. That's what I would say. So that's for China. I'd also think that India deserves a mention here. Indian bond market is attracting decent inflows, partly because of its inclusion in the EM bond index, but also because the economy overall and the yields are fairly attractive, adjusted for inflation. It's also a relatively decent high carry to vol ratio, with the currency being kept very stable by the Indian authorities and likely to remain so. That doesn't mean that the rupee won't fall. It's just that if it does, it will be very gradual adjustment. The one thing, though, is that India is already a huge darling. And anybody who's fled China has had to go into India simply by the composition of the MSCI index. There's no other market that is deep and liquid enough to absorb the outflows from China. So what's happened is that Chinese weights in the index have gone down, Indian weights have gone higher. And India, at over 20% of the index, now looks fairly overrepresented relative to its GDP share of the pie. Valuations are also relatively high. So that's, I think, the other side of it, that India looks attractive. It's the momentum play, also has a lot of positioning and relative ownership around it. So if China really starts to come back, it could actually sap the flows from India, and we could see a reversal from India back into China whenever that shift occurs. Mexico has also been a very, I think, fascinating market. It's also related to the US elections. I mean, 3-4 months ago, it was the absolute darling in EM. Mexico is benefiting from nearshoring, from high carry, from exposure to the US economy. And then they started to shut down on the border, and remittance growth just collapsed. Mexico also had an election, and it turned out to be kind of investors' worst case scenario, with a supermajority of a very left-leaning government, which then decided to push its case for constitutional change. We've now had a 20% depreciation in the peso. All the carry trades have been wiped out. Nobody talks about Mexico anymore. And I feel that at these levels, Mex is attractive once again. I think a lot of the weakness related to the constitutional change process is now in the price. Also, most of it is now in the rear view mirror, because as of this morning, the judicial reforms have finally been approved by the Senate. It's still a very volatile process, generating a lot of headlines. But I think, with the positioning gone and the valuation adjusted, we're at least kind of at a neutral point now, where Mexico looks no longer expensive, but yeah, it's not cheap yet. So it's more fair value, more kind of like neutral value. If Trump comes in, there could be another leg of weakness. But if not, I'd say, maybe we've kind of like already reached the lows as far as the peso is concerned. So yeah, I mean, lots of individual stories. I think, and these stories will change as we go along.
Okay, no, it's great. Okay, we've covered a lot of ground. So let's sort of move on to some personal questions now. One question I like to ask my guests are, what's the best investment advice you've ever received from anyone over your career?
Take a walk around the block. Now, this is when I was trading foreign exchange, and my head of trading, again at Deutsche Bank, he used to say this, like, you got an idea. So I was full of ideas, and I'd come to him, we got to do this. These are the reasons for it. These are the risks. This is how much risk I want to put on. And he would be like, he would hear me out completely, wouldn't say a word. Then he'd say, okay, now go and take a walk around the block and come back if you still feel as strongly. And I would. And, when I came back and I suddenly had doubts in my mind, he wouldn't say anything. We'd never talk about it again. And on the other hand, if I came and I still pushed it, he would ask no further questions and just put the trade on. So, and that really improved hit ratio, and it helped me to self-regulate. It taught me that emotion control is really half the battle. And I've tried to embrace that. Like, if you are right, the market's not going to run away in the next 10 minutes, 15 minutes, or even day or two, right? So you can afford to sit on it and stew over it and let it age in your mind. And if your own mind then starts to question it, you will, you've always had some leaps of faith in your thought process. And giving it a little bit of time helps you regulate your own emotional attachment to it. So take a walk around the block. You have an idea. It sounds really exciting in the moment. You really want to do something. Stay your hand, wait for a little bit, and come back to it. If you still feel strongly about it, do it.
That's a great piece of advice. I haven't heard that one before from anyone, but it makes a lot of sense. The other question I wanted to ask was, we do have younger people listening to the podcast as well. Many of them are students. Many of them could be or have recently graduated from university. What advice would you give them as they enter the real world?
Be a go-getter. The workplace is changing very quickly due to technology. You will probably have to retrain and re-specialize. The good news is it's never been easier to learn. Again, thanks to technology. Good luck.
Okay, great. And then a question on books. As you know, I like to ask this question. What are some of the books that have influenced you over your...
I love books, Bilal, and the list of books that your other guests have recommended is now a long list on my table, which I haven't read, and it just stresses me out. But look, I'll advocate for something that I am doing these days. About 30 minutes every day, I spend watching the Amazon Prime Great Courses Signature Collection. It's super cheap, like $6 per month or something. And I swear, this is not a sponsorship. They're not paying me to say this. But look, they've got courses on things, on very diverse topics. And it's usually like a university professor who comes and gives like a 20-minute lecture as part of a 24, 25, 30 courses, 30 lecture series for a single course. The level of the course is like a university 101 or 201 kind of a course, but the breadth is amazing. So, I mean, just within the last few months, I've taken courses on history of India, history of China, organic chemistry, quantum mechanics. And I'm really excited about my next one, which is how to read Shakespeare. So it's really good. So yeah, that's something which I'm doing these days. It's making a big impact on me.
Okay, I'll check that one out. I wasn't that familiar with that one. Okay, and then finally, what's the best way for people to follow your work?
LinkedIn and macrohive.com.
Great, that makes sense. Well, with that, thanks a lot, Mirza. It's been fantastic speaking to you, and good luck with all your various endeavors.
Pleasure, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.